The stock market is often portrayed as a path to wealth, financial freedom, and prosperity. Popular media, gurus, and influencers highlight stories of people making millions overnight, creating the illusion of quick riches. While there are success stories, this portrayal ignores a far more complex and unsettling reality. Beneath the surface lies a dark side: manipulation, systemic biases, psychological traps, and hidden risks. These often lead to substantial losses for the majority of participants. Understanding this hidden side is crucial. This video explores the dark side of the stock market in depth, examining its mechanisms and investor behavior. From the beginning, the stock market has been a highly asymmetric environment. Retail investors lack the advanced tools, analytics, and insider knowledge of institutions. This asymmetry creates a natural disadvantage for ordinary investors. Large institutions have teams of analysts and data scientists monitoring market trends in real time. Retail investors often rely on headlines, social media tips, or simplistic charts which can mislead them. Most end up following the herd, buying at peaks and selling at lows, reinforcing profits for sophisticated players. Market manipulation is one of the more controversial aspects of the stock market's dark side. Subtle strategies take advantage of human psychology and lack of information among small investors. Large institutions use tactics like pump and dump schemes, creating artificial price movements. High-frequency trading algorithms execute trades in milliseconds, influencing short-term prices. These practices contribute to market volatility, generating profits for exploiters while leaving investors vulnerable. The perception that stock prices move purely by supply and demand is misleading. Another critical element of the dark side is the psychological impact on investors. Humans are prone to cognitive biases like overconfidence, herd mentality, and loss aversion. Overconfidence leads investors to take excessive risks, believing they are smarter. Herd mentality causes people to buy into hyped stocks, resulting in bubbles that eventually burst. Loss aversion makes investors sell prematurely during market dips, locking in losses. Investing is not only a technical skill, but also a test of emotional control and mental discipline. The dark side is also reflected in the unequal distribution of information. Insider information, though illegal, occasionally leaks, creating temporary advantages. Institutions use private research and advanced algorithms to anticipate market movements. This information gap contributes to the rich get richer phenomenon. The illusion of equal opportunity in the market is partly a myth. High volatility and market cycles further emphasize the dark side. Economic downturns, global crises, or sudden political events can trigger steep market declines. Beginners often lack the tools to protect themselves, leading to devastating losses. Stories of individuals losing their life savings are common, highlighting the market's unpredictability. Another hidden danger lies in how financial institutions profit from retail investors. Brokerage fees, management charges, and hidden commissions can erode profits. Even low-fee platforms have indirect ways firms earn. From user behavior like payment for order flow, these practices reinforce the structural disadvantage faced by individual investors. Speculative bubbles are perhaps one of the most publicized aspects of the market's darker side. History is full of examples, from the Dutch tulip mania to the dot-com bubble. Investor enthusiasm, fueled by FOMO, drove prices far above intrinsic value. The eventual crashes left thousands with enormous losses. Human emotion and collective behavior can amplify risks, leading to catastrophic corrections. Media and online communities perpetuate myths about the stock market. This content often lacks context and fails to educate investors about risks. Retail investors may be misled into believing they can achieve wealth quickly. Consistent profits require discipline, diversification, and risk management. Regulatory environments also contribute to the market's dark side. Loopholes, delayed enforcement, and jurisdictional differences allow unethical practices. Regulations often favor large institutions, increasing the gap between professional and retail investors. Understanding the limitations of regulatory oversight is essential for approaching the market with caution despite these challenges. Not all is bleak. Awareness and education are powerful tools. Investors who learn analysis, develop emotional discipline, and diversify are more likely to succeed. The stock market rewards preparation, research, and patience more than luck or impulsive decisions. By understanding hidden risks, psychological pitfalls, and systemic asymmetries, investors can approach strategically. Another lesson is the importance of long-term thinking. Many dark side phenomena impact short-term traders more than long-term investors. Focusing on long-term growth and disciplined strategies reduces vulnerability. Risk management techniques further enhance resilience against unexpected downturns. Finally, the dark side of the stock market reminds us investing is not a game. It is a complex ecosystem influenced by psychology, strategy, regulation, and global events. Success requires respect for risks, understanding market mechanics, and emotional control. Acknowledging these realities is the first step toward becoming a smarter, more informed investor, equipping you with the knowledge to avoid common pitfalls and make informed decisions. Approach: investing with both caution and confidence.